I'm Edward Ocampo. I'm a senior advisor at the Bank of England, where I've been for the last 4 years. Before that, I spent 25 years in the private sector, most of that time at Morgan Stanley, various roles in fixed income. I'll let Jonathan introduce himself.
Good afternoon. I'm Jonathan Brown from Barclays, where I'm responsible for all of the lending activities and previously spent much of my career in the debt capital markets side of the business, and have recently joined the Sterling Working Group for risk-free rates about 6 to 8 weeks ago.
Yeah, thanks for coming to our session this afternoon. What we're hoping to do today is that I would provide you with a bit of an official sector perspective on interest rate benchmark reforms that have been ongoing in international markets over the last 5 years. And then Jonathan would provide some insights from the perspective of a markets practitioner in terms of what's going on. Each of us will talk for about 15 minutes, and then hopefully we'll leave some time at the end for you to ask any questions that you might have. I plan to cover 5 topics in my section before I hand off. Firstly, I want to give you a little bit of history about the Financial Stability Board's reforms of interest rate benchmarks. Then I want to talk a little bit about why further Libor reforms really cannot address the predicament that we currently face. Then I'll talk a little bit about the alternatives to Libor, which are risk-free rates. I'll talk about progress on benchmark transition so far, and I'll end talking about the challenges ahead before I turn it over to Jonathan. Reports questioning the integrity of Libor first emerged actually in 2008, so literally 10 years ago. And since then, international regulators, as well as market participants, have been working hard to reform interest rate benchmarks. The Financial Stability Board actually launched a review of interest rate benchmarks in 2013. I contributed to that review as a member of the market participants group back when I was still at Morgan Stanley. And in one capacity or another, I've been working on interest rate benchmark reform since that time. The final report of the FSB, which was published in July of 2014, actually recommended a multi-rate approach. It said that on the one hand, IBORs should be reformed to the greatest extent possible using transaction data. And secondly, that near risk-free rates should be developed and promoted as alternatives to IBORs. And the reason for risk-free rates is that through the work of the FSB with the private sector, it became apparent that risk-free rates are actually much better suited than IBORs in many applications where IBORs are currently used. So in the UK, the FCA has led on Libor reform, working very closely with Libor's administrator, IBA, and central banks have led on the development and market adoption of risk-free rates in the 5 Libor currency areas. In the UK, the Bank of England has taken on the administration of the sterling overnight interest average, SONIA, which many of you are familiar with, and we've reformed its methodology. We also convened a private sector working group, the working group for sterling risk-free reference rate, back in 2015, and that working group selected SONIA as its preferred alternative to sterling LIBOR, and they're taking forward plans to catalyze a broad-based transition to SONIA in sterling markets. The reason they selected one is they felt it was really important to aggregate market liquidity around a single index. Similar efforts are being taken forward by the Fed, by the ECB, by the Swiss National Bank, and by the Bank of Japan. The work in all international areas is market-led. but with internationally coordinated official sector support under the auspices of the FSB. So why can't further reforms to LIBOR address our current predicament? I can tell you that a lot of work's been done and that there have been significant improvements made to LIBOR since 2013. And in particular, governance and controls are much stronger. But reform efforts have not and cannot address the fundamental problem with LIBOR. And that's that the market that LIBOR seeks to measure, unsecured term deposits, is no longer active and no longer relevant. The Bank of England actually recently published an analysis based on new comprehensive data on sterling money markets that we collect on a daily basis from deposit-taking institutions in the UK that we regulate. And for maturities beyond overnight, unsecured deposits are very scarce, and average interest rates are highly volatile. For 6-month deposits, the most extensively referenced sterling LIBOR tenor, the median number and value of transactions for 2017 were only 10 and 87 million pounds, respectively. And I can tell you that those flows are a drop in the ocean in the context of sterling wholesale markets, and simply cannot underpin a robust benchmark. Our data actually reflects a fundamental change in bank funding models in response to the financial crisis. Banks no longer rely on unsecured money market funding. Now, that's actually a good thing. Those changes enhance financial resilience. But the absence of underlying markets does raise serious questions about the sustainability of LIBOR benchmarks that are based upon those markets. And further reforms simply can't compensate for a lack of transactions and the lack of an active market. LIBOR today is overly reliant on expert judgment, and markets remain overly reliant on LIBOR. International authorities believe that the disruption to financial stability could be very large if LIBOR was not available. Consequently, the international focus of reforms has shifted to developing alternatives to LIBOR and encouraging their adoption. And efforts are underway, working closely with market participants to develop contingency plans in the event of a cessation of the index. Thankfully, the FCA has worked hard and confirmed that existing panel banks have agreed to sustain LIBOR at least until the end of 2021. That gives some time to enable a transition that can be planned and executed smoothly. But the clock is ticking. So what are the alternatives to LIBOR? What are these risk-free rates? International authorities, I would say, have worked in each jurisdiction closely with market participants to develop and select these near risk-free reference rates. In all cases, they're overnight rates, which provide a relatively pure read on risk-free rates in each economy. Sterling markets, the risk-free rate working group chose the sterling overnight interest average, a benchmark which is now administered by the Bank of England. We actually took on the administration of SONIA in 2016, and we reformed this rate, put in necessary reforms to enhance its robustness and reliability in April of this year. So it's literally just recently been reformed. SONIA has been available since 1997, and it is already deeply embedded in the fabric of sterling wholesale markets. It's an index that's used in the overnight interest rate swap market, and there also have been FRNs off the index, and there will be more. And it's a rate that's paid on cash margin in many applications, and it also forms a basis for the discount curve that's used to value cleared derivatives as well as most uncleared derivatives. So the benchmark transition in sterling markets isn't starting from scratch. The wide use and acceptance of SONIA does provide a big head start. Previously, as I said, the benchmark was administered by a private sector administrator and was only capturing a very small subset of the market. The bank actually took it on because we were able to use our statutory powers under the Banking Act to collect a much broader set of data. In fact, we think we're covering now 95% of the market in the data that we're including. And SONIA is now underpinned by a daily average of 375 transactions with an aggregate value of over 50 billion pounds a day on average. Similar near risk-free rates have been selected as LIBOR alternatives in other jurisdictions. The US Alternative Reference Rate Committee, working closely with the Fed and convened by the Fed, selected the Secured Overnight Financing Rate, or SOFR, as their preferred LIBOR alternatives. SOFR is based on the US Treasury repo market, and it provides a broad measure of the cost of borrowing cash collateralized by Treasury securities. SOFR is also grounded in a very deep and liquid underlying market, and there's some 800 billion of trading activity on a daily basis in SOFR. The euro markets have not yet selected a preferred alternative to euro LIBOR, although they are hard at work, and their own euro risk-free rate working group started a bit later than the groups in the US and in the UK, but they're, I would say, working at a much faster pace, and they expect this fall, this autumn, to have announced the risk-free rate alternative for euro markets. I can tell you that a leading candidate is the euro short-term rate, or ESTR, a new overnight unsecured deposit rate, which will be published by the ECB based on its money market statistical reporting data. So ESTR there are many parallels between ESTR and SONIA. In addition to providing a euro LIBOR alternative, ESTR is also expected to provide a fallback for EMEA. EMEA is currently an important benchmark for the euro markets, but it may not be available after 2020. Work is ongoing to reform Euribor as well, using a combination of expert judgment and transactional data. So what progress have we made on benchmark transition to date? In November of last year, the bank and the FCA launched the next phase of work in sterling markets with UK market participants, and the risk-free rate working group was significantly expanded to include a much broader set of market participants. The original working group was really dominated by banks and broker-dealers who are active in sterling derivative markets. The group now includes corporates, supranationals, and includes representatives from the global capital markets, from loan markets, includes insurers, it includes infrastructure firms. It's a much broader set, and it's a set we need now because the mandate has changed. The original mandate was let's develop and select a risk-free rate. The mandate now is let's catalyze a broad-based transition off of sterling LIBOR and on to SONIA over the next 4 years. The US ARC and the working group on euro risk-free rates are also working with expanded groups and are working not just, the Euro group is not just working on the selection of a risk-free rate, they already have work streams going on market transition. All of the risk-free rate working groups across the globe who are working in close coordination. All of them have technical groups, subgroups that are actively involved in the real mechanics of what's necessary to transition markets. For example, here in the UK, ICMA is leading a very important group on transition for in debt capital markets. Now, transition planning in OTC derivative markets is very well advanced, at least in sterling markets. There are new futures contracts that have been launched and are already trading for SONIA. There are also contracts that have been launched for SOFR that are trading. As I said, in sterling, there's already a very active OIS swap market that's based on SONIA. And at the end of last year, actually the clearing eligibility for SONIA OIS was extended out to the full range, out to 51 years. So across the entire yield curve now, SONIA swaps are clearable. And we have seen a significant uptick in activity in the long-dated SONIA swaps. So that work is ongoing, continues to progress in derivative markets, but where the real focus is right now is in the loan markets and the debt capital markets, where planning was at a less advanced stage, but is now progressing more quickly. I will say that moving loan and bond markets off a benchmark that reflects bank funding costs does represent a significant conceptual and practical change. We do recognize that. But I personally believe that it's both feasible and desirable. Corporate loan and debt markets do not need benchmarks, which incorporate bank funding costs. And it certainly makes no sense to measure those costs in markets where banks don't fund, which is where we are today. And in fact, many users in our outreach have indicated to us that they prefer to have their funding linked to more stable rates, like SONIA, and not be subject to spikes in funding levels during periods of stress in the banking system. So what are the challenges ahead? The market feedback we've received so far suggests that there is strong support for risk-free rates as LIBOR alternatives. And there are early signs that market transition is gathering pace. But we're under no illusions that this is going to be easy. LIBOR transition is fast in scale, complex, and does entail risks. Market participants note several challenges ahead. I will mention two that come up over and over. The first is that LIBOR is available in a range of tenors, with 3- and 6-month rates most common, while risk-free rates are overnight rates. Many end users have indicated a strong demand for risk-free rates, which are more compatible with existing benchmarks. In other words, available in term, 1, 3, 6-month terms. The second issue, which is comes up again and again, is that there is a significant stock of long-dated LIBOR contracts with inadequate fallback provisions, and addressing the risk involved with those contracts is no easy task. I can tell you that work is going on to address both of these issues. You should expect to see a consultation on term SONIA reference rate from the risk-free rate working group this summer. And you should also expect to see a consultation from ISDA on new contractual LIBOR fallback provisions for OTC derivatives. The plan is to incorporate these into legacy contracts via a protocol process. I think I'll hand it over to Jonathan now and let him speak more about these and other issues from the perspective of a market participant who's deeply involved in this work for his own organization and also working with the risk-free rate working group.
Thank you. So I think what I'd like to do is really give a bit of an overlay to those comprehensive comments from the official sector and just give a bit of some input and observations from the working group and from the private sector. And as I mentioned at the beginning, I've only been involved in the working group for the last 6 to 8 weeks, which is at that point when it moved into transition of LIBOR once the benchmarks had been chosen. And I think that's an interesting point to join. And we'll talk a bit about education, and there's a lot of education needed in the marketplace around this initiative, and I'm certainly going through that at the moment. But to share some early observations, I think, as Ed pointed out, the early part of this work was dominated by derivatives, options, and futures. That is corresponding to about 80% of the usage of all of the Libors if you add the markets together for the various currencies. So it's no surprise that that side of the market took the lead in terms of the debate and the discussion in the early process. But as we moved on to transition, input was very quickly asked for and given from the bond and loan side of the business, which is obviously equally important in terms of the usage and the importance of the various Libors. And so it was, as I said, it was an interesting time to come in. I think it's a point where there is much need for consultation and feedback. And part of my speech here is embedded a request for feedback and viewpoints to be fed into the various working groups, and I'll go through that as we proceed. But as Ed said, I think one of the, if we look at the immediate challenges as we look at it from a capital markets perspective, the fact that we're replacing term rates with an overnight rate quickly got the attention of bond issuers and investors from the FRN side of things, but more importantly the loan market, where the ability to have term rates is embedded in that business. And so whether it's from an operations systems point of view and the need to change all of that infrastructure, whether it's an accounting, hedge accounting point of view, or very importantly, an asset liability management point of view, where treasurers like to know 3 months ahead what their rate is going to be on the loan. These are all important challenges and hurdles that we need to overcome in terms of how we look at a spot risk-free rate in terms of term reference. It's very good and very positive to see that the LMA and EMEA are involved in those processes and those working groups, and as Ed said, a consultation is underway in the sterling side, and I'm sure it will be in the other currencies as well. The fact behind it, though, over the medium term, the overnight rate will become much more liquid, much quicker than Libor, as you heard from some of the statistics just now. Over time as well, the overnight rate will become a cheaper source of benchmark, given that liquidity that's embedded. So although it is a huge challenge, it's something that we need to find solutions with in the near term. The second point is regarding the legacy contracts, and again, Ed gave a very good introduction to that. And if you look at loans, or more importantly on bonds, the fallback language included in documentation of existing activity is extremely penal. So the idea that you would just rely on fallback language and do a duty as a treasurer to your organisation doesn't seem to make common sense. You'll be falling back by and large on rates that are completely liquid and really lacking any observable data. So it's a major risk event, and a reason why ISDA is very much at the centre of providing replacement language. And I think you'll see that adopted very quickly. Clearly, as we go through this journey over the next 3 or 4 years, trying to prevent the stock of Libor-based funding growing at the same time is extremely important. And so I would encourage you to look at that replacement language as that comes through the relevant work streams and becomes communicated. I want to touch also on the urgency of the project. There's obviously a 3-4 year time horizon. If I compare it personally to some of the other changes we've had in our industry, whether it's MAR or MIFID, plans around Brexit, etc., these things had a momentum very quickly. And I think the observation here is that, as Ed mentioned, the official sector is not really leading in terms of the solution here. They expect the private sector to solve the issue ahead of us. In addition to that, we've heard that the panel banks will provide quotes on Libor until the end of 2021, and there is the lack of a cliff edge, for the want of better words, in terms of having to get this in and operational by any particular date. But again, there is an urgency to prepare and to educate around the subject if you're going to be funding efficiently in the future. It's easy to be complacent around it. There was a recent press report that some panel banks may continue to be beyond the end date as agreed of 2021. Libor may indeed be extended. But if the various working groups, the official sector, come together with private sector, by the time that we reach that date, the liquidity on SONIA and the other risk-free reference rates will be such that those will be the rates that efficient treasurers should be using in terms of funding. So the liquidity of the overnight will be a true measure of the risk-free rate. So in the same way as you may rely on term rates initially as we develop term rates, in the same way you may rely upon Libor still being available, it's clear that over the path of the next 3 or 4 years, this set of risk-free rates will provide efficient, liquid and observable benchmarks to take forward. In terms of advice that we're seeing given out at this stage, I've mentioned education. I think that's important, that obviously this subject matter touches various different parts of organizations, whether it's treasury funding on the investor side, on the intermediary side with trading desks, obviously derivatives we spoke about, bonds and loans. There's a huge education process that needs to be started and quite quickly, and I think you'll see some of the working groups start that process very soon. It's also important, I think, if you have Libor exposure, to start to assess those across the various currencies, across the various maturities, to understand the exposures, the risks that you are running as you go into this process. And then think about the products that you would like to see developed for the market. It's really clear, as in many cases in the global capital markets, that change like this is often accelerated and momentum is gathered by leadership and innovation. And so I think it's very encouraging to see the EIB announce their sterling-based floating rate note of the coming days, which is going to be linked to SONIA. So I think the more we have sponsorship in the market to understand the challenges, to learn the lessons and get the market up to liquidity quickly, I think the sooner we can have a real true risk-free rate that stands on its own 2 feet ahead of any Libor extinction dates that we might see. Should we go to questions?
That's fine. So thank you very much, Jonathan. We wanted to leave some time for questions. I think we have around 10 minutes or so. So if you have questions, if you can please state your name and the organization that you're from, and then we'll try and answer your questions.
Romano, Intesa San Paolo. Thank you for your overview, very interesting. Can I ask for your opinion of view regarding different jurisdictions selecting different near risk-free rates? So some are collateralized or some aren't. So what is your view in terms of interaction of these currencies, maybe in cross-currency products like FX, or do you see issues in different paths chosen by different jurisdictions? Thank you.
Thank you. That's a very good question. I'll say that in all markets, the intention of risk-free rates is the same. And if you look actually at the underlying interest, the actual definition of SONIA, the definition of itself doesn't mention whether it's a secured rate or an unsecured rate. It is what the definition says is it's an overnight short-term rate in wholesale markets that's free of credit, liquidity, and other risks. So it's a rate that you'd expect to be closely tracking the central bank policy rates in whatever region that it's been selected for. The actual selection of risk-free rates themselves was left to market participants in each market. And we have to remember that was important because markets are different, and there are market structure is different, market participants are different, and there are good and valid reasons why the best read for a risk-free rate in the U.S. markets was deemed by market participants to be a rate that was secured against U.S. Treasuries. Whereas in the U.K., there was a lot of work and looking at gilt repo rates, but the decision really was that in the U.K., gilt repo rates are actually quite affected by the availability of collateral of gilts, and there were some fairly significant effects at quarter ends and year ends, which a lot of users weren't that comfortable with, whereas Sonia was much more stable, easy to understand, already well embedded in markets, and tracked the policy rates very well. Now, in terms of the interaction of these rates, I would say that the actual curves, the risk-free curves that derivative markets would trade off these rates, will be very compatible, or they should be very compatible. I say will, they should be, because remember, they're trying to capture the same concept, and I would have expected, if you look at a 3 or 6 month point on the Sonia curve, and a 3 or 6 month point off of a SOFR curve, I would expect that the basis there to be quite understandable, and in some ways easier to deal with than the cross-currency basis that you see across some LIBOR markets, which can be fairly significant and can be volatile and can be affected by credit conditions bank credit conditions in various areas. So I hope that gives some answer to your question.
Hi, Gilda Suri from Axiom Alternative Investments. So if we look into 2020, and we find that Euribor is 20 basis points over Easter, how do you see the discussion between an issuer and an investor if they disagree on this spread? So do you see a trustee coming into play, or do you see more a statutory law imposing a spread on both parties?
Want me to take that question? Okay, so I'll say right now that I'm not a member of the Euro risk-free rate working group, and that particular work on EONIA and how EONIA will fallbacks for EONIA and how that will work is being taken forward by the ECB and that group. So I can't respond definitively to how that will work. I do recognize that it's a challenge, and I can tell you that in the UK, maybe we were quite fortunate, but we thought hard up front about how we would assist the market with developing an overnight risk-free benchmark. And we decided early on that the best thing was to actually take on the administration of Sonia and evolve that rate as seamlessly as we possibly could. Even though we did change definition, even though we have 5 times as much data coming into it, by taking on the rate and evolving the rate, it does make the transition easier. Unfortunately, the ECB doesn't have that option. They have to work on introducing a new rate and having a transition. The Swiss have just gone through a similar process, moving from TOIS to Saron. They didn't have the benefit of being able to do a seamless, what I would call a seamless transition, an evolution. They had to change rates. Now that is a much smaller market, but it does show that it is possible to do that transition. I expect that there will be work coming out of the Euro risk-free working group. I think it will be subject, I imagine it will be subject to a fair bit of public consultation, and whatever choices are made about how that transition works and what the mechanisms are not ones that will surprise people. It will be well advertised, and I know the intention of the ECB is to ensure that there isn't market disruption and that the transition mechanism is fair to market participants. Are there any other questions? You're allowed to ask Jonathan questions.
Well, thank you very much.
Thank you very much for coming, and enjoy the rest of the conference. And thank you to Euromoney for inviting us to be here.